Good morning, everyone. Whether you're sipping your first coffee or heading out the door, today's story is one that touches every Canadian, even if you don't always notice it. Today, we're diving into a decision that quietly shapes our financial lives. The Bank of Canada's choice to keep its main interest rate steady at 2.25%. This isn't just a headline for economists or bankers. It's a move that ripples through the entire country, affecting households, businesses, and communities from coast to coast. This isn't just a technical move for economists. It affects everything from your mortgage to your savings account. When the bank sets its rate, it influences how much you pay for your home, how much you earn on your savings, and even the price of groceries and gas. For families planning their budgets or young people saving for their first home, these decisions can make a real difference. The bank's job is to keep inflation low and stable, using its policy interest rate as a key tool. By raising or lowering this rate, the bank tries to keep the economy balanced, making sure prices don't rise too quickly, but also that growth doesn't stall. By adjusting this rate, the bank can either cool down or boost the economy. If things are overheating and prices are rising too fast, a higher rate can slow things down. If the economy is sluggish, a lower rate can encourage borrowing and spending. Right now, the bank is holding steady after a year of rate cuts, signaling cautious optimism. This pause suggests that while the worst may be behind us, the bank is watching closely to see how things unfold. This suggests the economy is stable, but there are uncertainties ahead. Global events, trade negotiations, and even weather can shift the outlook in unexpected ways, making the bank's job even more challenging. The bank is balancing good news with potential risks, aiming for that economic sweet spot. It's a careful dance. Too much caution could slow growth, but moving too quickly could let inflation get out of hand. In the next sections, we'll break down what interest rates mean, why the bank is pausing, and how this impacts you. We'll explain the basics so you can feel confident about what's happening and why it matters. We'll also look at the influence of U.S. trade talks, inflation, and jobs. These factors all play a role in the bank's decision, and they affect everything from the price of imported goods to the number of jobs available in your community. Finally, we'll help you understand how these decisions affect your personal finances. Whether you're a student, a parent, or planning for retirement, the Bank of Canada's choices matter. Let's get started and see what this means for you and your future. Let's break down interest rates in a way that makes sense for everyone. Think of them as the price tag attached to borrowing money, or the bonus you get for saving it. They're everywhere in our daily lives, even if we don't always notice them. Whether you're putting money into a savings account, swiping your credit card at the store, or taking out a loan, interest rates are quietly shaping your choices and your wallet. At the heart of it all is the Bank of Canada's policy rate. This single number acts as a benchmark, setting the tone for everything from the interest on your mortgage to the rates businesses pay to expand and hire. When the bank raises its rate, borrowing becomes more expensive. That means higher payments on mortgages, car loans, and credit cards. It's like tapping the brakes on the economy, slowing things down to prevent overheating. On the flip side, when the bank lowers the rate, borrowing gets cheaper. This encourages people and businesses to spend, invest, and take risks, like pressing the gas pedal to speed up economic growth. The bank's challenge is to keep the economy running just right, not too hot, not too cold. It's a bit like adjusting a thermostat, aiming for that perfect balance where growth is steady and sustainable. This single rate quietly shapes the financial decisions of millions of Canadians and thousands of businesses every day, from buying groceries to launching new ventures. The ultimate goal? To keep prices stable so your money goes further, and to support strong job growth so more Canadians can find work and thrive. By adjusting the rate, the bank manages inflation, making sure prices don't rise too quickly or fall too much, and helps support employment across the country. It's a delicate balancing act, requiring constant vigilance and careful analysis of economic signals from across Canada and around the world. Even the smallest change in the policy rate can send ripples through the entire economy, affecting everything from the cost of groceries to the pace of new construction. That's why the bank's decisions matter to all of us, whether we're managing a household budget or running a business. Understanding how this works helps you see why today's steady rate is significant. It's a signal that the bank is working to keep our economy balanced, stable, and strong for everyone. Why is the Bank of Canada holding its rate steady at 2.25%? The answer comes down to one word: caution. In a world where economic signals can change quickly, the bank is choosing to move carefully rather than rush into new decisions. Right now, the Canadian economy is showing signs of stability. We're seeing modest but consistent growth, strong job numbers, and inflation that's largely under control. These are all positive indicators suggesting that the economy is on a solid footing. However, there are still plenty of uncertainties, especially on the global stage. International events, trade tensions, and shifting markets make the bank hesitant to make any sudden moves. The world economy is interconnected, and what happens abroad can quickly impact Canada. Last year's rate cuts are still working their way through the financial system. The effects of those decisions take time to show up in the real economy, so the bank wants to wait and see how things play out before making another move. Right now, the current rate sits at the low end of what's called the neutral range. This means it's not actively boosting the economy, but it's not slowing things down either. It's a balanced position, designed to keep things steady. Some financial experts are calling for even lower rates, hoping to give the economy an extra push. They argue that more stimulus could help businesses and consumers. But for now, the bank is comfortable with its current stance. It believes that patience is the best approach in this environment. By hitting pause, the bank gives itself time to gather more data, analyze trends, and watch how both domestic and global events unfold. This careful approach helps avoid unnecessary risks. The bank's next move will depend on new information, especially developments in U.S. trade talks and other international factors that could affect Canada's outlook. For now, the bank is choosing patience over risk, preferring to wait for clearer signals before making any changes. It's a strategic pause in an uncertain world, a move designed to protect the economy from unexpected shocks and give policymakers time to respond wisely. The future path for interest rates and for the Canadian economy will be shaped by what happens next, both at home and around the globe. For now, the bank is watching, waiting, and preparing for whatever comes. Our economy is tightly linked to the U.S., making trade talks crucial. The USMCA renegotiations are the biggest source of uncertainty for the Bank of Canada. Any changes could impact key industries and jobs across Canada. The bank knows monetary policy can't fix problems caused by new tariffs or trade barriers. That's why they're waiting for clarity before making any big moves. Until the trade picture clears up, caution is the safest path. The bank is watching closely, ready to respond as needed. The Bank of Canada monitors two vital signs: inflation and jobs. Inflation is stable and within the bank's 2% target. Good news for everyone. If inflation rises too fast, rates go up. If it falls, rates might be cut. Right now, stability gives the bank room to pause. The job market is also solid, with steady hiring and low unemployment. A healthy job market means more spending and economic growth. But the bank stays alert. Job numbers can lag behind other changes. For now, controlled inflation and strong jobs support the decision to hold rates. The bank is watching for any signs of trouble. This careful approach helps keep the economy on track. Numbers matter, but so do feelings. Business and consumer sentiment shape the economy. Right now, both businesses and households are cautious, mainly due to trade uncertainty. Businesses are holding off on big investments, and consumers are wary about the future. High household debt adds to the caution. The bank's steady rate aims to calm nerves and encourage stability. Raising rates now could hurt confidence and slow the economy. By holding steady, the bank hopes to keep optimism alive. Experts are split on what comes next. Some predict a rate hike if trade talks go well and the economy strengthens. Others see a possible rate cut if risks grow or the economy weakens. Most now expect the bank to keep rates steady for the rest of the year. The uncertainty reflects the tricky balance the bank faces. For now, waiting is seen as the safest move. The future depends on how key events unfold. Setting policy is harder than ever in a globalized world. The Bank of Canada must watch not just local trends, but global events, especially U.S. decisions. Trade negotiations like the USMCA are out of the bank's control, yet have huge impacts here. The bank can only react to global shocks, not prevent them. This uncertainty limits what interest rate changes can achieve. Canada's economy is deeply tied to global forces, bringing both benefits and risks. That's why the bank values caution and clear communication. Transparency helps manage expectations and avoid surprises. In uncertain times, stability from our institutions is crucial. The bank's steady hand helps guide us through global turbulence. What does a steady rate mean for you? If you have variable rate debt, your payments won't rise for now. Good news for your budget. This is a chance to pay down debt or build an emergency fund. Savers, however, will see modest returns, as banks keep savings rates low. It's a trade-off: low borrowing costs, but lower savings growth. The bank's decision aims to keep consumer confidence steady. Big purchases like cars or appliances won't get pricier, yet. But the message is clear: manage your finances wisely and prepare for change. The bank is watching and waiting, and so should you.